Today's 752nd day to come here to learn. I'm learning. I hope this will support your dreams, your goals, allow you to become the person that you want to become. Last 3 days, I shared the different paths in career. You can be employee, you can be self-employed, you can be a business owner, and today we'll focus on a path, investor path. What kind of mindset? What kind of words? What kind of things that they really care about? Because every single career path have different kind of mindset and different kind of vocabulary that they use. So they will share what kind of vocabulary investors use, what kind of mindset they use to really move forward in their path. Now, I understand that investor path is a little bit different because you need to have something from other paths to be able to support your investor path. But when you, of course, you do due diligence, you invest your time, you invest your money. Now, when you become an investor, full-time investor, now, of course, you're able to make sure that you are looking for vocabulary. Because when you know what vocabulary you're able to use, when you speak with people, because the way how you speak will attract certain people. So knowing what vocabulary investors use, you're able to connect with different kind of people. So they will share 18 things that the investor cares about, and really what kind of mindset or vocabulary do they use. So number one is passive income generation. Passive income generation. That means we understand that we're able to put money in for a long time. It depends on our strategy. Some people put the same amount of money into one company and keep it for 10, 20, 30, and even more years. They're able to generate dividends, they could generate some other income, but at the same time, it grows in value. So their assets is growing. And you are making money just passively. At the same time, there's a lot of different strategies, not just in stocks, but of course, that passively is still an interesting word because if you invest in real estate, you still need to find the deal. So you need to be able to do the analysis to find the deal. But after a while, after you invest your time, it becomes passive. Number two is portfolio management. So every single investment needs to understand, okay, do I put all the eggs in one basket, or do I really have my portfolio managed by myself or managed by someone else? So what kind of things I put into my portfolio? What kind of investments do I manage? It's very, very important to understand that portfolio management is very important to manage risks. So number three is the risk management. Risk management. So how much do you want to invest in different asset classes? It could be real estate, stocks, bonds, money funds, money markets, like cash. So commodities, there's so many different areas that you're able to invest. And when you diversify, you're able to manage risks. So risk management is very common vocabulary in investors speaking. Number four is financial market expertise. So that means if you really want to invest with the highest level in stocks, forex, or anything between, you need to have financial expertise. Without financial expertise, you will not be able to make or maximize your income. So the more you know, the better you will have, the more chance you will have to win in this investing game. Number five is capital growth. Capital growth. Now, of course, we want something that want cash flow, so we want some kind of dividends or returns. We want something to want to appreciation, and we want our capital to grow. There's a lot of different ways how we are able to increase our capital, but at the same time, the number one thing of investor is how to make sure that I have $100,000 and make it to $200,000. When I have $200,000, how I make $400,000? Because when you start to double your income, and the faster you double your income, the better investor you are. Now, of course, it depends on the risk management tools as well. Number six is liquidity and asset allocation. Liquidity and asset allocation. So that means when you think about how liquid you want to have that investment, how liquid, how fast you want to grab that money from the investment. Because when you put money in real estate, it's not liquid. It could be that you put in real estate for 3-5 years. It depends on the construction. Or if you have cash, it's super liquid. You just take your card and you just put the money in. There's a lot of different investment asset classes that you're able to be more or less liquid, because it's very, very important, because sometimes more liquidity allows you to jump on opportunities that this could bring you higher returns. But if you keep too much liquidity on you, that means a lot of times, because very high liquidity shows that a lot of times you do not have higher returns. Number seven is hand-off approach. I think this hands-off approach is very, very interesting. Again, this is very similar to passive income, but hands-off approach, that means that when you invest it and you leave it, You will not do anything. It could be that you don't do anything with that investment for a long, long time. But again, you need to invest a lot of time at the beginning. You put a lot of work at the beginning, at the front end, but you don't do anything at that back end. The only do what you do at the end is just getting returns. Number 8 is market research and analysis. Now, of course, if you're an investor, you need to understand market. You need to do analysis. If you, of course, give other people to invest, you're not fully an investor, a full-time investor. You just, and of course, if you give your money to someone else to manage it, you probably will not know market. It will not know analysis. But at the same time, if you want to be a full-time investor, as your own investor, as you working by yourself, you will need to know market. Number 9 is a risk-reward ratio. A risk-reward ratio. This is very common vocabulary for investors because okay, how much I'm able to put risk and how much will get rewards, how much I will get returns. And the higher risk, most time is the higher reward. Now, the lower risk, the lower reward as well. So everyone needs to manage their risk and reward ratio. That could be not too high or not too little because you want to make more money and not lose it. Number 10 is financial independence and wealth creation or wealth building. In financial independence and wealth creation. So investor most time is really focused on wealth creation, is independence, because you do not need to anyone to say anything what you need to do. You're able to control your time, you're able to control your schedule, you're able to control where you invest and how much you generate. So that means that financial independence is a lot of times created in investment side, as an investor, because business owner now, of course, allows you to really create the cash flow. But now when you invest that cash flow into investments, you're able to create that full financial independence. Number 11 is passive and active income. This is very, very important, and we need to understand that a lot of times our active income is funding our passive income. Our active income is funding passive income, because you're not able to make passive income without active income majority of the time. So that means we need to maximize our active income that we could maximize our passive income. Number 12 is asset preservation. Now, of course, one thing is make money. Other thing is really keep it. Because first lesson that's from Warren Buffett is that never lose your money. And second lesson is never forget the first lesson. So that means when we really make money, what do we do to protect it? What do we do to preserve it? And what do you do to really invest and still make money out while you're preserving your money and wealth? Number 13 is an investment horizon. So that means, of course, when investors, we're able to say, okay, we're able to invest in daily things, we're able to invest in yearly things, we're able to invest in decade things. So what are your main horizons, where you want to invest? Because the shorter the period, the more speculative that era is, because you don't know exactly how it will look like. When in the longer perspective, you all start looking into more fundamentals, how the world will change and where that will go. I need to understand how that works. Number 14 is tax strategies. Tax strategies. There are so many different investment strategies that you're able to implement to make sure that you maximize your taxes. So when you think about money and saving money and having the most growth on your money, sometimes we need to think not just how to make money, but again, how to save as much as we can. And how to do that? That means that we're able to implement the best strategies, how legally we're able to save money by not overspending on taxes when we don't have to. Number 15 is goal setting and financial planning. Goal setting and financial planning. That means that we need to understand, okay, what is our goal? How much we want to make? Because at the end of the day, like when you have that goal, let's say $1 million. And let's say, like, how much do we have now? We have $100,000. So now when we know our goal is $1 million and we have $100,000, now we need to understand, okay, what is the gap? How fast we want to reach that? And when you know how fast we want to reach it, we know exactly what kind of asset class we need to look for to grab the investment return that we're looking for. Because when you have the starting point, end point, and you have the time frame, now we know exactly what kind of investment return we need to have to really maximize our goal and financial planning. Number 16 is risk tolerance and patience. people who invest in the long term need to have a lot of patience. Sometimes you don't need to have patience. You need to forget about it. You invest in, have it on a portfolio, review once in a while, but always forget it. And have that patience, because the investment is not one day thing. It's a year thing. It's decades to think. So we need to have patience for the funds to really grow and start seeing, because it's very interesting that we understand that number 17 is reinvestment and compounding. So that means when you see the growth, now you're able to reinvest, or most importantly, you start to see that the power of compounding, because you made money. Now you start making money on the money that you made. And now after that, you start making more money on the money that you made. And after a while, it's start to compound more and more and more. Because Warren Buffett has made 99% of his wealth after 50, because he understood that building wealth is slow. And most people don't build wealth because they want a shortcut. But the easiest and fastest way to build wealth is slow. Number 18 is market timing. Market timing. And what it means that it's you need to understand when to enter and when to exit. When to enter and when to exit. Because exactly with any kind of investments, it could be real estate, it could be stocks, bonds, anything, commodities. Knowing when to really make that purchase and when to sell is very, very essential. Because at the end of the day, you make gain based on what you bought, and then how much you sold for that for. And a lot of times, if you sold for higher, that means you made money. Of course, there could be some different things, including into real estate, that you need to buy, then you need to develop and then sell. And of course, the selling price could be higher, but still, like, you're able to lose money if you spend too much time on development. But again, we need to understand that entry and exit is one of the most important things when we consider how investors making money. So there's a lot of different things when you think about investor and how they speak and how they think, because this is just part of vocabulary that we need to learn towards moving to investors. Because I truly believe that in life is everything in steps. So employee, self-employed, business owner, and then moving next step to investor. I learned that I love the one sentence that I learned today is that it doesn't matter how small your first step is. It doesn't matter how small your first step is. What matters is how big is your last step. It doesn't matter how small your first step is. What matters is how big is your last step. And that's why when investors, when you're starting small and making just a couple of dollars a day and moving as employee and moving slowly to self-employed, a business or an investor, and investing that money in, I start seeing the compound effect. And the last step will be a huge if you just follow the easy steps. So I hope you just win, and see you tomorrow.